Welcome to the Telltales podcast, where we discuss cash flow and its pivotal role in investing. Join our email list at telltales.us to get the cash flow memo. It's about 20 pages covering 80 companies, U.S. government's finances, and the energy sector.
It's like having a masterclass on investing in your inbox every week.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
Oil pricing is kind of like the stock market. It's weak. All commodities are weak. The most often quoted cause is China. We go to Exhibit C, you can see the China demand is supposed to be up 400,000 barrels, 25 versus 24. It's kind of looking like it might be less, maybe even flat. I think the U.S. demand at 300,000 is okay. Europe's about flat. India's okay. Japan's flat. Generally, developed countries are flat in terms of consumption. You can see the Middle East, which is rather large, 9.6 going to 9.9. I think that's pretty likely to happen. So then the question becomes, the 104.7 for 25 up from 102.9, will that be more like 104? In other words, will the increase be 1,100,000 units rather than 1,000,009 or whatever it is? That comes down to Saudi Arabia and UAE and a few others with extra production sticking at their current production rates, or not too much more than their current production rates, rather than a reduction in set-aside production of 900,000 barrels. I think all that will happen. What'll be the result? No one's talking about $100 oil anymore, but I think oil hanging in the 70 range is a little more likely than less likely. When you turn the page to Exhibit B, you can see the oil price there, which was 75 last Thursday. By the time you got to 26, it was 67. So you have a fair amount of backwardation. My belief is that when we get to 25 and 26, the futures curve will be a pretty good predictor of where we're going to wind up. Could oil break and go into the 60 or 50? I mean, anything can happen, but I don't think that the extra production in the hands of Saudi Arabia and UAE is going to be in favor of doing that. The alternative, when we've had these plunges in the past, some of it's been like COVID related, the alternative outlook would be having Saudi Arabia be upset with other producers overproducing as compared to their quotas and saying, if you want to do market share, we'll put all our oil out in the market. I think that's unlikely. I would rate that as not more than 10 or 15% probability. In natural gas pricing is very low. You can see the current month here on Exhibit B is 206. It's just extraordinarily low that's October. So hopefully we get a bounce. Now, the key isn't demand so much as that top line in the table of production. Now, production this year is going to average 102. The forecast here for 25 is 105, which would be 3 Bs up. That looks like a lot of increase, but keep in mind that the 102 includes curtailments of around 2 Bs a day from 2 Marcellus producers for most of the year. So the production is there. It's a little bit like Saudi Arabia and UAE. The 2 producers are EQT and Chesapeake. And they're pretty able to curtail Marcellus production because it's unusual as compared to other gas fields. When you curtail production, the pressure builds up. You're probably adding to your reserves. So at these kind of prices, I assume those 2 producers will continue to curtail. But if the market were $3.40, which is what the futures curve says for 2025, we would see that production. Now, the Permian keeps going up. You see the top, or the Permian's 18. That's probably the next time we update this schedule, that'll be 19. The Permian is all associated gas, so it's going to get produced as long as new oil wells are brought on. There's been a delay in moving the gas from West Texas to the Gulf Coast. There's a big pipeline called Matterhorn, which has been delayed by a few months, new capacity. So the price in West Texas for September, if you sold your gas on a first month basis, is a minus $1. You have gas you have to dispose of. You got to pay someone $1 to take it, which is really extraordinary. Once the Matterhorn pipeline comes in, I think that will disappear. But that 102 with some curtailment in the Marcellus and lower production in the Haynesville, what I think may happen with these very low gas prices, that all other will start to decline rather than be flat, but time will tell. On the cash flow statement for the U.S. government, we are going to have, before we're together again next Wednesday, we're going to have the debate between Kamala Harris and Donald Trump, I believe next Tuesday. The question of additional revenue is going to come up. If you look at the 24 forecast, which would be the fiscal year that our government's on a September 30 fiscal year, so that 2.47 is individual income taxes. More money from there is going to be hard. The payroll tax is something that just happens automatically to support Social Security, Medicare. Corporate income tax seems low, I think 570 billion. But you have to keep in mind, if you try to tax corporations here, they can always move their tax headquarters somewhere else. So I don't really see, if we're looking to have a worthwhile debate, I don't really see how either side can make the case for more than about $5 billion of revenue. When you cite down the expenses, Social Security at $1.45 billion or $1.45 trillion, that's Medicare and Medicaid. I think those are set. Federal pensions are set. Veterans pensions are set. Other veterans expenses set. So when you add all that up, it comes to $3.43 trillion. Interest is hugely increased. If you go back to 18 and 19, that was under 400 billion, and now it'll be approaching 900 billion. I don't know what you do about that. We incurred the debt. Interest rates are higher. Defense, don't think there's a great, maybe you could do some reorientation in defense, but I don't know that you can really reduce it much beyond 820 billion. All other, in the years prior to COVID, was running about 900 billion. Now it's $1.4 trillion. If you really went to work, maybe you could, that $500 billion increase, maybe you could reduce it by 200 billion. But that still leaves you with $1.6 trillion. Now, you've seen numbers of $1.9 trillion. I think the difference between $1.6 trillion and $1.9 trillion is student loan forgiveness, which I don't really think is a cash flow expense. What's the answer here? I don't think there is an answer. How does that affect us as investors? Let's turn to page 1. And these are not updated. These are numbers from the page 1 numbers are from a couple of weeks ago. But one of the things you notice here, if you go down to page 1, these are 5 of the Magnificent 7. Go down to EV times free cash flow and cite across the page. Apple's 34 times, Amazon's 40 times, Alphabet is 33 times, Microsoft is 44 times, Tesla doesn't really count. We turn the page to page 3, so we pick up Nvidia. Despite Nvidia's decline, recent decline, its earnings have been so strong that they're under 50 times and that level. And that free cash flow of 62 billion, 112 billion, that's kind of the recent run. Most people are projecting Nvidia results are quite a lot higher than that. So they may be getting. So what does 30 times free cash flow mean? 30 times free cash flow means about a 3% free cash yield. The 10-year treasury is now 380, 390. We haven't begun to bring the Fed funds rate down, which is 5.25, I guess. Clearly, with the slowdown in the economy and higher unemployment, fewer jobs created every month, the Fed is going to bring that Fed funds rate down. How low will it get? The terminal rate, as they call it. I suppose it's reasonable to expect that eventually, maybe not by this time next year, they'll get it down to 3.5 or so. If your 10-year bond, which is kind of the base rate in the economy or the base rate on a worldwide basis, is still in the 370, 380 range, doesn't 30 times free cash flow or 3% free cash yield represent value when you have these companies that have these, really dominant positions? These companies' positions are so strong, target for our antitrust, even though there's no transaction. The latest one being Nvidia, Google, Apple, Amazon, whether it's antitrust from the US or antitrust from Europe, they're targets because of their very strong position. So I'm taking a lot more time than I normally do at the beginning of these calls, but we're going to turn over to Mike and Jason to go through these companies. I'm going to challenge them to indicate that there is flaws in any of these companies that would cause you to not want to buy them at 30 times free cash flow. I mean, 30 times free cash flow seems like value investing to me. And with that, I'll stand down for a while and see what kind of reaction I get from Mike and Jason.
30 times free cash flow is a lot more than what we would have paid for any of these companies 10 years ago. And what does that mean? That means that there was a big misconception among the market in general as to the ability for these larger technology platforms to grow. And, what did we see in that period of time? We saw Microsoft successfully transition to a subscription-based Microsoft Office. Microsoft Office hasn't changed its cemented position as being the number one business tool for enterprise. And meanwhile, they've built out Microsoft Azure. So they become more entrenched as a necessary part of the enterprise software ecosystem. Every one of these kind of Mag 7 names, you can look at them and say, 10 years ago, we didn't think they were going to be as big as they were, or in the case of Tesla, a lot of people bet that they weren't going to survive. But what they've proven wrong is that large companies can grow revenues at relatively high rates over long periods of time. That was fundamentally misunderstood as a possibility. And we've always kind of figured that technology companies in general are going to be better equipped to be able to do that. Nvidia, on the other hand, I mean, this is a case of a company that was just really far ahead of everyone. And at 47 times free cash flow, and here I have it 40 times next quarter on a run rate basis, and I'm pretty conservative in how we calculate free cash flow. Pretty incredible position they're in. The DOJ scrutiny is probably just validating as to how dominant their position is. There's lots of people competing, building products to try to compete with NVIDIA, but NVIDIA's got a 15, 20-year lead on them all. So it's going to be a while before anything of substance is able to compete with them. So to dial it back to 30 times free cash flow, I think the market in general is better equipped to estimate the durability of the cash flows coming off these companies. And if you're willing to pay 30 to 50 times free cash flow for Costco, you better be willing to take a look at these companies as well.
Jason, are you gonna take the opposite position, or how are you going to align yourself here?
I can give you both. The position and alignment is we've been looking a lot at projections for energy usage in data centers across the country until the projections usually go out to 2030. And they're projecting that to increase anywhere from 2 to 3 times what it is today. So if you look at the energy consumption that's expected from all these data centers, that's going to be a lot of NVIDIA chips that people are purchasing to do that. So if you're paying 30 times cash flow now, they'll double that potentially in the next 5 years. And that's a target we look for, right? So I think one thing that gets misunderstood that Jensen talks about in the earnings calls and when he does interviews and all that is he discusses the transition from CPU computing to accelerated computing, and that's using his GPUs. Everyone looks for these downstream customers, who's going to use all the data center capacity that's being built out today. And I think that's kind of the wrong way to look at it. It's how are the tools that we're currently using today transitioning from CPU to GPU. I think a lot of that's hidden from the consumer, so we don't see it happening, but it's definitely happening. So all the recommender systems, the ad placement systems on the internet, your Netflix algorithm, that was probably all a rule-based algorithm in the past. And today, now they're AI-powered, accelerated computing algorithms. Another example is Amazon announcing that Alexa is moving to Anthropic's model. That's just another workload that's transitioning from a CPU to an AI GPU infrastructure. So that's going to happen across the board. We kind of see AI as table stakes. It's we won't be calling it AI-powered applications in the future, and hopefully in the next couple of years, it'll just be software. And it'll be taken for granted that these GPU-powered AI algorithms power a lot of the decision-making behind the scenes in the software that you're using.
And to add to that, Jason, the point about where's the revenue going to come from for this stuff, you made the point that it is going to be table stakes. And with that in mind, these software as a services companies are all going to have to compete more, whether you're enterprise software or consumer. They're going to have these features in them in order to be competitive. Probably means the prices for a lot of stuff will have to go up, but I don't think you'll be able to be competitive as a software provider without incorporating these tools into your products.
So I guess I didn't give you the negative, the downside.
Counter, yeah, give a counter. Mike and I are being way too optimistic, I think.
Yeah.
So we badly need a counter here before our 30 minutes is up.
Yeah. So NVIDIA is in the position that Intel was in the decades past. They dominate the data center. They're the one customer you have to go to if you want a performant, in this case, a GPU to run your software. That can absolutely continue, but we see these hyperscalers don't like having NVIDIA monopolize that market. The one thing that the generative AI algorithms are great at is translation. And you can kind of think of writing software as translating from human ideas and human language into machine code. So it's really good at writing code. Potentially, it could accelerate the development of a competing software to CUDA and allow you to use competitor GPUs just as effectively as you can NVIDIA GPUs using some other AI-generated compute library. So that's a threat to NVIDIA dominating, with.
I think that's
potentially 95% market share.
I'd say that's a threat to every single one of these Mag 7 companies, or even the top, Salesforce, ServiceNow, Snowflake. All of these companies are, if the easier it is to develop software, whatever the use case of that software, whether it's embedded or whether it's customer facing or whatever, the easier it is to produce software, the more competition there's going to be, and that's going to drive a lot of productivity and value. It doesn't necessarily mean that it's all going to translate to profits for the software providers.
If someone were able to come up with a competing system to CUDA, is it likely to be Amazon or Alphabet with their own GPUs, or is it likely to be ADM or somehow help come back from the dead, or how is it likely to happen, do you think, Jason?
Yeah, Amazon and Google have competing chips. They have said that they will not sell them commercially. AMD certainly is trying to compete. And they have a competing software model called ROCm that competes. That it's analogous to CUDA, but it's always playing catch up. They started developing on that probably 10 years after Nvidia developed CUDA. So can they catch up with the software library? Because the software really is the moat for these Nvidia chips. And can they catch up with using AI tools? And it's a threat, but so far, AI has been writing software now for at least a year, and it doesn't seem like they've used that to catch up.
Well, I'd also add that the software moat is also dependent on the people that have used the software. So it's not just, even if ROCm was 100% exactly the same, had all the same functionality, if it's not easy for a software engineer, even with the use of AI, if it's not easy for them to incorporate that code, not as easy it is with NVIDIA, they're just going to keep using NVIDIA. So I do agree they'll chip away, they may chip away at NVIDIA's lead here. I mean, it's hard to get more than where they are as far as market share. I mean, they're damn near 100%.
It's true, and everyone's using CUDA and NVIDIA, and all the libraries are built on top of it.
But I guess, if you want to pull on this thread farther, if the generative AI gets better, and the generative AI gets better at writing and optimizing code than humans, does it matter what language you're on? Maybe not, and maybe these are things that we're not going to see at least for a couple generations of these frontier models. But the expectation is in 2 or 3 generations, we're probably going to have some pretty significant advancement in the capabilities of these models, which could completely change the way software is developed. So all these things are risks, but I don't think you can. I don't think it warrants a different view on the world.
Yeah, hypothetical at this point.
So that we don't go a whole 30 minutes without mentioning healthcare, anything new on Vertex or Lantheus or Harrow or Lilly or BioNTech or any of the other healthcare companies we regularly discuss?
Well, Vertex ran afoul of UK regulators with a LinkedIn post. I think it's not a big news event, but it was kind of amusing. They announced the approval of a drug, a UK approval of the drug on social media, which ran afoul of they've considered it breaching their regulations against pharmaceutical advertising. For Lantheus, I believe it was a week or 2 ago, I was discussing how Novartis was selling off their radiopharmacy business in Europe. A development since then is they've announced that they're going to, here in Carlsbad, California, they're going to build a new production facility for radiopharmaceuticals. So it looks like they're divesting the business in Europe and then being more competitive in the US. Also, another related to Lantheus and their Alzheimer's diagnostic, we've been researching a company that offers the diagnostic imaging at a point of care rather than the supplier. They sell a lot of Pylarify diagnostics, but But as it relates to Alzheimer's, they're doing a considerable amount of business with MRI brain imaging. So one of the concerns was, and Lantheus's imaging agent is not FDA approved yet. It's being used in clinical trials and large clinical trials, but it's not approved yet. And then the worry was, does that market materialize? Is there going to be, are payers going to reimburse for imaging, brain imaging to diagnose Alzheimer's? So it appears that market is growing, has materialized, and now it's up to Lantheus to gain approval and make inroads there.
Right. Got a couple minutes left. Let me just ask you an Nvidia question that you guys are much better qualified to have a view. Is there the possibility of Nvidia trying to bring Blackwell, a year after Hopper? Is there a chance that they just get into more trouble than they've announced now? I guess they had poor yields on their initial runs, but I mean, how much more complicated making the Blackwell product is compared to the H200 product does it look? I mean, what's your view there?
Well, I think a 2-month delay is nothing in the grand scheme of it. And you look at how many years Intel's been delayed, but we decided not to dog on them too much anymore. They've intentionally delayed product in the past when they had such a lead on the competitors. So I don't know if this is necessarily a bad thing. They have all the demand for the previous generation chip that they need, and they're going to sell that at a higher margin. The Blackwell chip is a lot more complex. It's 2 chips fused together into one. So it is a much more complicated process. I think, there's going to be a learning curve there. And the fact that it was just a 2-month delay is, I don't think it's too big of a deal there. Do you have a different take, Mike?
No, I actually think they probably looked at it and said, hey, this is an opportunity to make some design tweaks that would improve yields, and they don't have any reason to rush it out. So I think it was probably partly strategic.
I guess the concern I'd have is that chip designers got ahead of the ability to get yields.
Well, they are using some relative. You remember that the chip designers work very closely with Taiwan Semiconductor, or the fabs, and by working with them, they're typically designing ahead of the implementation of technology. So there are going to be hiccups along the way. So I don't think it's completely unexpected. It's the Intel case study is the one that you always go back to. Is management decided that they were going to stay on DUV because of cost concerns, and they were probably surrounded a little too much with yes men that said, okay, we can figure out how to do this with DUV. And they did, but they never could get the yields of where they wanted them to be. So could you have that same problem at Nvidia working with Taiwan Semiconductor? Absolutely. But it will affect the entire industry broadly. So, you wouldn't expect AMD to be able to produce something better than Nvidia. They're going to be subject to the same constraints.
Good. Well, we're a couple of minutes over. I think we've covered the waterfront. And I promised next week to be less long-winded. But I thought it was an opportunity to tie the macro situation that we face, that our candidates running for president face, in with what is value. So that's a one-time thing. We will be much more specific next week. In the meantime, everyone be well and stay healthy, and we'll talk exactly 7 days from today. Take care.
The views expressed on this podcast are the hosts alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to and no reliance should be placed on the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future and may or may not hold positions in the securities mentioned.